Welcome back. We've covered some ground in terms of understanding the basics of credit default swaps. We now understand the mechanics of CDS. We also understand what is a standard CDS contract, what is an upfront fee, how CDS are quoted in the market, and how that CDS quote is converted into the upfront payment. Now let us extend that understanding by looking at how CDS are traded in the market. When would somebody want to enter into a CDS trade, and how would she capture her gains and losses? To understand all of that, we will once again take Glencore as our example. And we'll look at that chart we shared earlier. Let's rewind to September 2015, when Glencore was under tremendous pressure due to the crash in mineral prices. Now, Glencore is one of the world's largest commodity companies. Therefore, the fall in prices of minerals and other commodities naturally created a big hole in its finances. On top of that, Glencore had a massive debt burden. Its net debt on the balance sheet stood at a whopping $30 billion at that time. And this is net debt, meaning it is total debt net of cash on balance sheet. No wonder then the market was concerned about Glencore's ability to pay back its debt in this environment of falling commodity prices. And this created a massive reaction in Glencore CDS. The 5-year CDS spread went from 350 basis points to 850 basis points in the space of just 2 weeks. That's 500 basis points wider in just 10 trading sessions. That's a lot for a company as big as Glencore. Now, if you were holding the bonds of Glencore back then, you would naturally be worried, wouldn't you? What would you have done? The most logical thing to do would be to buy protection in Glencore. In other words, buy the Glencore CDS, because the chances of Glencore defaulting on its debt has increased significantly. But would you buy the CDS when it was trading at 350 basis points, or would you buy it when it was at 850 basis points? What I mean is, would you buy it 2 weeks early or 2 weeks late? Now, this is a dilemma most investors have to face. Today we are discussing this case with the benefit of hindsight. But back in September of 2015, when prices of commodities started falling, you couldn't tell whether it was just a correction or whether commodities have indeed entered a bear market phase. It would have taken you a couple of weeks at least to come to figure that out. And by that time, the spread would have spiked from 350 to 850 basis points. It was that sharp and abrupt a move. So, if you had bought protection against default on Glencore, you would most likely have paid a price closer to 850 basis points. Let's assume you paid 700 basis points to buy the Glencore 5-year CDS. And as normally happens, after a sharp move higher, there's a pullback, and then the original move resumes. The same thing happened with Glencore, as you can see. In the next few months, things kept getting worse for the company, and by January of 2016, the 5-year CDS was trading in excess of 1100 basis points. What then happens to the CDS you bought in September for 700 basis points? You're sitting on a 400 basis points profit, aren't you? Because you bought something at a cheaper price than what it is today. Now let's step back a little and recall from part 2 of our series. We said that a buyer of CDS is short credit risk, which means the buyer stands to gain if the credit risk worsens or increases after she has bought the CDS. In other words, the CDS buyer gains if the probability of default increases after she has bought the CDS. That's exactly what has happened here. Glencore's probability of default increased after you bought the CDS in September of 2015, because commodity prices continue to fall, and that created more and more uncertainty over its ability to pay back debt. Now imagine you did not buy the Glencore CDS back in September of 2015. Instead, you sold the CDS. What would have happened? You would be sitting on a loss, isn't it? In the markets, one person's profit is another person's loss. So if the buyer is sitting on a 400 basis points profit, the seller is sitting on a 400 basis points loss. Another way of looking at it is the CDS seller is long credit risk. So if the probability of default increases after selling the CDS, the seller has to suffer a loss. Because for the seller, the chances of paying up on the contract increases with a rise in default probability. It's exactly the reverse of what happens in case of the buyer. At this point, you may be wondering, why would someone sell a CDS on Glencore when things were looking so bad for the company? Does it make any sense at all to take over Glencore's credit risk in that kind of an environment? Well, if you look at the trading volumes back then, you will see that along with spreads, the volumes had also spiked up sharply at that time. Which means that while the demand for buying protection increased in September of 2015, that demand was met by an increase in supply. So people were indeed selling CDS during that period to meet that increase in demand. But it still doesn't answer the question, why were they selling? To understand why they were selling, let's assume that you are a hedge fund manager and you feel just because the probability of default has increased, it does not mean that Glencore will actually end up defaulting. Why is that so? Because Glencore was rated investment grade, which means its credit rating was high. Surely it would not want to destroy its reputation in the market or jeopardize its access to capital by defaulting on its debt. Plus, Glencore is a massive company with assets spread across the world. If need be, it could sell some assets to pay debt. It could also stop paying dividends or raise fresh equity from the market. In short, there were many levers Glencore could pull to ensure it does not have to default on its debt. So as a hedge fund manager, this seemed like a good opportunity to capitalize on the stress that Glencore was going through and lock in 700 basis points or 7% every year for the next 5 years. Of course, the hedge fund would be exposed to the risk of default. But if it feels that there will not be a default, it seems a risk worth taking for the 7% return that you would be making every year in that kind of a low yield environment that was prevailing back then. And indeed, that is how a market is made. Different people have different views about what you call the reality. Right then, we've seen why somebody would want to buy or sell a CDS. But once you've entered into a CDS trade, you may not want to hold it until maturity. Instead, you may want to exit the trade earlier by booking your profits or losses. How would you do that? To find out how you can book your profits or losses on a CDS trade, let's fast forward to January of 2016, when the Glencore CDS spread crossed 1100 basis points. And as we said, the buyer then was sitting on a 400 basis points profit and the seller was sitting on a loss of an equal amount. Now these are mark-to-market gains and losses, mind you. They have not yet been realized or booked. So how do you book this profit or loss? One way to do that is, if you are a buyer, you can go back to your original seller and ask her to buy it back from you at current market price, which in this case is 1100 basis points. You basically square off your position with your original counterparty. Remember, you bought the CDS at 700 basis points, and let's assume you paid around 8% of notional upfront or 8 points upfront to buy the CDS. Now, if your counterparty buys it back from you at 1100 basis points, let's assume you receive around 20% of notional upfront or 20 points upfront. So you've made a profit of 20 minus 8 or 12% of notional on this trade. Remember, the notional amount is 10 million because you're selling back the same CDS to the same person you originally bought it from. Your profit, therefore, is 12% of the notional of 10 million, which is $1.2 million. And you've also paid one quarterly premium in these 4 months, so that needs to be subtracted too. Now, what happens after you've squared off your position? Well, the coupon payments stop because you no longer have the protection from credit risk, so you no longer pay the coupons. Now, all this is great if your original counterparty is willing to buy back the CDS from you. But what happens if she does not want to buy it back? What if the seller wants to enjoy the 7% of annual premiums instead of buying it back and booking a loss? What would you do in that case? Well, fortunately, you have another option. You can go looking for a buyer who's wanting to buy protection on Glencore and is willing to fork out 1100 basis points for doing that. Now you can imagine, in most cases, it's not going to be easy to find a buyer when the CDS is trading at such high spreads, because most people who are looking to hedge their bond holdings in Glencore would have bought the CDS already. So there wouldn't be a great deal of hedging demand left in the market anymore. Who then would buy the CDS back from you at that higher price? This is where the dealers come into the scene. Dealers are essentially market makers. Their role is to ensure that the market functions as smoothly and as efficiently as possible. So if the hedge fund which sold you the Glencore CDS at the first place is not interested in buying it back, you can sell a fresh CDS in Glencore and most likely find a dealer or even an actual investor willing to put in a bid for it. Again, your payoffs are the same. That is, you earn 12% of notional on the net, just like you would if you squared off the position with your original counterparty. The notional is also the same, 10 million, and the coupons are the same. You pay 500 basis points on one leg and receive 500 basis points on the other leg. So the coupons essentially cancel each other out. The only difference is you are now involved in two CDS transactions on Glencore. And because you're long on one CDS and short on the other, you are essentially default neutral. Meaning, if Glencore defaults, you neither receive anything nor owe anything to anyone. This is known as unwinding a CDS trade. What you have done is you have unwound your original long CDS position with a short position on the same reference entity. After unwinding a position, all you're doing now is paying 500 basis points of coupon to the hedge fund on the long position and receiving 500 basis points in coupon from the dealer on the short position. But why would you want to do that? You have nothing to gain or lose from this trade anymore. You have pocketed 12% of notional as profit and you are default neutral on Glencore, which means if Glencore defaults, it does not matter to you anymore. So in reality, after unwinding an open CDS position, the two offsetting trades are simply cancelled. This process is known as netting. In our example, your long CDS trade with the hedge fund and short CDS trade with the dealers are netted out. After that, the surviving counterparties are the dealer and the hedge fund who have a long and a short position respectively. Now, all of this was from the perspective of the buyer of Glencore CDS. But what about the seller? The imaginary hedge fund in our example, which sold protection on Glencore to earn an annual income from Glencore's troubles. Obviously, they were betting that no matter how bad things got for Glencore, it is not going to default, because it would not want to lose access to capital markets in the future by defaulting on its debt. Plus, there were enough resources within the company to ensure it survives through this difficult period. And sure enough, over the next quarters, Glencore stopped dividend payments, sold non-core assets and raised fresh equity. Have to admit, Glencore also benefited from a recovery in commodity prices. So if you look at its CDS chart again, by September of 2016, that is exactly 1 year from the time metal prices crashed, the spread had narrowed to just 200 basis points. So our hedge fund is now sitting on a cool profit. When it sold the CDS for 700 basis points, we said it received around 8% of notional upfront. Now, if it wants to buy it back at 200 basis points, how much does it have to pay upfront for buying it back? Well, interestingly, it does not have to pay anything upfront. Instead, it will receive an upfront payment because the cost of buying protection, which is 200 basis points, is less than the standard premium on Glencore CDS, which happens to be 500 basis points. So how much is it going to receive? The upfront fee that it is going to receive is the present value of this difference, 500 minus 200 basis points, over the next 4 years, not 5. Why not 5? Because it sold a 5-year CDS 1 year back, and now there are only 4 years remaining until maturity. So let's say the upfront fee that the hedge fund is going to receive is approximately 10% of notional. What does the hedge fund end up making on this trade? It makes 8 plus 10 or 18% of notional on this trade, plus 500 basis points of premium that it earned over this 1 year. Now that's a cool 23% of notional in just 1 year. Remember, this kind of return was possible only because the hedge fund was willing to take the credit risk of Glencore. That means it was willing to be on the dock if Glencore defaulted. Higher the risk, higher the return. And now that the chances of default has reduced significantly, so much so that it is hardly a possibility anymore, it makes more sense for the hedge fund to exit the trade now and earn a 23% return rather than carry it till maturity and earn only 7%. But wait, how is it going to square off the position? Remember, it had sold the CDS to you and you've already exited from the trade when spreads touched 1100 basis points. So it can't buy back the CDS from you anymore because you're no longer there in the market. But it can always find a dealer or some other investor in the market with whom it can unwind its position, right? As we discussed earlier. The mechanics of the trade are exactly the same. The hedge fund will still make 8% plus 10% plus 500 basis points of premium, which amounts to 23% in total for 1 year. So that gives you an idea of how CDS are traded in the market. In the next episode, we will focus on the why. Why would somebody trade a CDS at all? So if you're interested to know more, we'll see you then.